As we move forward in our discussion of the GAAP conceptual framework, it might be helpful to go back and review where we've been. We first defined what GAAP was, that is, as the established standards that represent the guidelines for gathering and communicating accounting information. They represent the authoritative word on which events should be recorded, when they should be recorded, how they should be measured, what should be disclosed with respect to that particular event, and then how the financial statements themselves should be prepared. I gave you a quick overview of the development of generally accepted accounting principles, and then we moved into the GAAP conceptual framework itself. The first level of the framework is to define the basic objective of financial reporting, and that is that financial reporting should provide information useful to present and potential suppliers of capital, equity investors, lenders, other creditors, and so on, that they can use to make decisions about providing resources to the company. The second level of the GAAP framework represent what are called fundamental concepts. These are the building blocks of accounting theory. And we discussed, first of all, the qualitative characteristics of accounting information. That is, the information, the qualities of information that we need in order to have valid and relevant information. We discussed the fundamental qualitative characteristics, that is, those that were essential to providing relevant information and useful information, but also enhancing qualities, attributes that improved the usefulness of that information. And there was an overriding constraint on the recording or accumulation of information, and that was cost effectiveness or cost benefit analysis. We also discussed the basic elements of the financial statements and those definitions that I instructed you to memorize. Hopefully you've started on those already: assets, liabilities, equity, revenues, expenses, gains, and losses. Those are important elements to represent the building blocks of the financial statements. The third level concerns, first of all, the basic assumptions. Third level overall concerns recognition and measurement concepts, but there's some basic assumptions. An assumption really is a foundation, a given that we don't have to defend in and of itself. The principles that we get to in this next section really stem from, or they refer back to those assumptions. And so that's where we're headed now, to look at the recognition, measurement, and disclosure principles. In general, an item should be recognized when it meets these four criteria. And again, to recognize simply means that we record that event, that transaction, and include it in the information that we provide under GAAP. The definition: the item meets the definition of an element of the financial financial statements. Sorry, lost track. That measurability, there's a measurability requirement or criterion that the item can be measured with sufficient reliability, that the information is going to be recognized. It has to have relevance, that is, it's useful in decision making, and that it is reliable, or it has the quality of reliability. The information is representationally faithful, verifiable, and neutral. Let's take a look first of all at recognition. Recognition is a concept that concerns both what is to be recorded and when it's to be recorded. By the way, you might look back and see here, since when it's to be recorded is important, that can be understood as referring back to the periodicity principle, the periodicity assumption that we looked at earlier. The revenue recognition principle states that revenue is recognized only when it is both realizable and measurable. Realizable here means that it's collectible. In other words, you have essentially, there's a couple of things involved here: that the seller has done what they need to be able to, let's say, have a claim against the buyer. They've conveyed the product, or they have completed the service, so they are due payment, and there is the full expectation that the buyer is going to be able to make good on that. That is, to be able to make payments. So there are really two elements to the notion of collectability. One has to do with having provided the service or the product so that in fact the buyer owes that money, and also that the buyer has the ability to make good and to make that payment. But also measurable. That is that we can, with some reliability or with adequate reliability, determine how much should be recorded. Most of the time it's pretty easy to tell when revenue has been earned, especially when we're dealing with the sale of goods. When you go to Walmart to buy let's say a bag of Doritos or something like that, there's an argument in accounting theory that the earning process has already begun. You made that decision maybe back at the house, and you came to Walmart with the intention of buying that product in mind. As you walk in the store, once again, someone could say, in one sense, the earning process is already started, or it's already in process. But then as you go and stand in the checkout line, once again, you could say, you've got that bag of Doritos there, and someone could say, see, the earning process is almost complete. But it's not complete, is it? We all know when that process is complete, and that is when title passes from the seller to the buyer, and that happens only when you provide payment that Walmart accepts and when they give you the receipt. That receipt is evidence that you own that product. Think of it as a title, in a sense, to that good. And even though you and that product are still on Walmart premises, if somebody else wants to buy that, they have to deal with you, not Walmart. And so it's pretty easy in general to tell when title passes, and therefore when to recognize revenue when it comes to a sale of goods. It's sometimes it's not quite that easy, even when it concerns sale of goods. I may tell you some stories in class about that, but I worked years ago, and one of the clients that I had was a paper company. And so they produced large rolls of cardboard, well actually brown paper that was used to make cardboard boxes. And they came off of the machines in huge rolls. Imagine a huge roll of toilet paper that's about 8 feet long ways and about 6 feet or so in diameter. And they had inventory that was finished goods like that. Then they had train cars of chemicals, because a lot of chemicals are used in paper processing. And some of those chemicals would be on the premises of the company, but they would not be owned by the company yet. And so it was sometimes we had to look at bills of lading to determine what the company actually bought, what they owned versus what was still in essence owned by the seller of those goods. When services are involved, it can be more complicated because you may have situations where the job is only partially completed. We probably assume that if you call a plumber out to your house to do some work, that they have earned that pay only when the job is completed to your satisfaction. Now, there can be, let's say you're talking about building construction, you can have situations where construction of a large building can span multiple accounting periods. And so, the question is, if they've started the job but they haven't finished it, how do they record revenue? Do they wait till this long-term project is complete? Or do they measure revenue based on some percentage of completion? And so those are interesting questions. And in fact, the rules with regard to revenue recognition have changed even in the last couple of years. So we'll have to deal with those later in a separate detailed section. Some businesses will earn and record revenues before they receive payment. This is not foreign to us. We understand the whole notion, for instance, of accounts receivable, that a business may convey the goods to a customer, but the customer will be given 10, 15, 30, 60 days to pay. But the seller has already conveyed the goods, so they have done what they need to demand payment by the buyer. And so they will record an account receivable. So that of course is going to be accomplished through what we call the accrual, or under the accrual approach, or the accrual basis of accounting, as opposed to the cash basis. Sometimes, though, a company may receive payment before they've earned the revenue. Very common example is when you have subscriptions, whether it's to access to a software package or an app or maybe a magazine, where someone will pay Outdoor Life $25 for an annual subscription. Now, when Outdoor Life actually receives that $25, they haven't earned a dime of it. But as they actually issue those magazines month after month after month, then they earn a pro rata portion of that. So in this case, of course, if they receive payment before they've earned the revenue, then in truth, when they receive that payment, when Outdoor Life receives the payment from the customer, they owe the customer either to provide those magazines over the life of the subscription, or to return the customer's money. And so we might imagine a number of situations where a law firm or an advertising firm may charge a retainer, that is a deposit toward future work that they will do for a customer. And we just have to realize that when they receive payment in advance of actually providing the service, then that represents a liability to the seller until they have actually earned that, provided the service and earned that income or that revenue. The expense recognition principle, better known as the matching principle, says that costs should be recognized as expenses at the same time as the related revenues are recognized. In other words, that the recording of expenses is really inextricably linked to the recording or the earning of revenue. Sometimes it's very easy to determine when that, how to do that matching, how to accomplish that matching. For instance, when you buy that bag of Doritos from Walmart, they record that sale that day, but they also will relieve their inventory for the cost of that bag of Doritos. It's a very sophisticated system they have, and of course even smaller companies now can have that kind of information available through technology. But notice this: while that bag of Doritos is sitting on the shelf at Walmart, it's an asset. It's waiting to be sold. In one sense, an asset exists with a purpose of waiting to be sacrificed. It's a store of value waiting to be sacrificed in exchange for revenue. Whereas when that bag of Doritos is sold, then it's been sacrificed in exchange for revenue. So the company would record the revenue, but they'd also have to move the cost of that bag of Doritos from the category of an asset, specifically inventory, to the category of expense. An asset is rightly described as a consumed cost, and an expense as unconsumed cost, and an expense as a consumed cost. Both of them represent cost to the firm. But while it's an asset, it's waiting there, waiting to be sacrificed in exchange for revenue. And once it is sacrificed, then that cost moves to the category of expense. There are, of course, a number of items that are really difficult to, let's say, tie to a particular transaction, like inventory is. Things like depreciation on assets. You can imagine that as a piece of production equipment is used up and it loses value, that we record depreciation. But it's really not possible in most cases to tie that loss of value to any particular items, particular assets. Even tougher is things like utilities, or the cost of, say, the president's salary, or the cost of running the accounting department. All of those represent cost to the business, but they're hard to tie down to relate to a particular dollar of revenue, a particular transaction. So generally what we do is we will identify those costs with a particular period rather than a particular transaction or product. And that yields, when you have cost accounting, you'll see that, or even managerial accounting, that we have to distinguish between what are called product costs, that is, those that relate to, that are tied to a particular item that we can sell. So we can tie that cost of goods sold to revenue, versus period costs, those that can't really be tied to a particular product or event, and we just have to really expense those in a particular period. Sometimes it's easy to connect the expenses with the related revenue, like when Publix sells